Welcome to the deep dive. Today we're tackling something pretty important, how inflation messes with the stock market.
Yeah, it's a big one. Understanding this connection is, well, really key if you want to get a handle on the economy or your investments.
Definitely. Think of this as maybe a shortcut to grasping a major economic force that's always kind of lurking in the background.
And we're drawing heavily today from some great insights put together by Miss Mansi. She does a really good job making it accessible, especially looking at it from an Indian perspective.
Right. So our mission for this deep dive is to pull out the core ideas from her work. You know, how rising prices hit the market, which areas get hurt most, and which ones maybe hold up better.
Sounds like a plan.
Okay, so first things first. What is inflation in simple terms, and why should we even care?
Basically, it just means your money buys less over time. Miss Mansi used a good example. Bread costing €100 today might cost, say, 110 next year. That increase, that's inflation.
Got it. So your purchasing power goes down. And in India, we track this with the CPI, right? The Consumer Price Index.
Exactly. That's the main measure. It tells us how much the average cost of everyday stuff is changing.
Now, Ms. Mansi mentioned that not all inflation is bad news. There's a difference between moderate and high inflation.
Yeah, absolutely. A little bit, maybe 2 or 3%, can actually be fine. It often suggests the economy's growing, people are buying things.
Okay.
But when it starts creeping up, 7% or higher,
Yeah.
that's when alarm bells start ringing for economists and definitely for investors.
Right. That high inflation is what really spooks the stock market. So let's get into the mechanics. How does that actually ripple through and affect stock prices? Ms. Mansi points out a few key ways. First up, higher costs for companies.
Yeah, this one's pretty direct. When inflation's high, everything a company uses, raw materials, paying its workers, energy, it all costs more.
Makes sense.
She gives the Tata Motors example. Imagine steel prices shoot up. Suddenly it costs, I don't know, maybe 50,000 more just in steel to build one car.
Wow. Okay.
Now, if they can't just raise the price of the car to cover that extra cost, well, their profits get squeezed.
And when profits drop, investors tend to react, right? Stock prices might fall.
That's the typical chain reaction. Lower profits often lead to lower stock prices.
Okay, so rising costs hit profits. What's the second impact? Something about consumer spending.
Exactly. When essentials cost more, food, petrol, electricity, people just have less money left over for the non-essential stuff, the wants rather than the needs.
Right.
Think about that 80,000 OnePlus phone Miss Mansi mentions. If your grocery bill just jumped, maybe that fancy new phone gets put on hold.
Yeah, you prioritize.
So companies selling those non-essential items see their sales drop, and lower sales usually mean
Lower stock prices again. Makes sense. Okay, third point, the link between inflation and interest rates. This comes up a lot.
it's crucial. When inflation is running too hot, the central bank, the Reserve Bank of India, or RBI, here often steps in.
To cool things down.
Precisely. They raise interest rates.
Yeah.
And that makes borrowing money more expensive for everyone.
For companies wanting to expand and for us wanting loans,
Yes. Higher loan costs for businesses, higher EMIs for consumers. It puts the brakes on spending and borrowing, which generally slows down the whole economy.
and a slowing economy isn't usually great for stocks.
Not usually, no. Plus, companies face higher borrowing costs themselves. Ms. Mansi pointed to 2022 when the RBI raised rates because of global inflation.
I remember that.
And we saw a definite impact, especially on tech stocks in India. They felt it quite a bit.
Okay, so higher rates act like a brake. What's the fourth way inflation hits stocks? Something about investor expectations. This sounds a bit more psychological.
It is, but it's really important. See, a stock's price today is largely based on what investors think the company will earn in the future.
Right, future profits.
But when inflation is high, that future money is worth less in today's terms. Think about it. 100 promised 5 years from now buys less if prices go up every year.
Ah, okay. The value erodes.
Exactly. So the present value of those future profits drops. Investors become less willing to pay high prices today for earnings way down the road.
Especially for companies whose big profits are expected, like years away, like tech startups.
Precisely. Those growth stocks, as Ms. Mansi notes, can look less attractive. Investors might prefer companies making solid profits right now.
So high inflation basically makes future money look less valuable today, hurting the appeal of growth stocks. Okay, let's pull this together. What's the general takeaway from Ms. Mansi on inflation in stocks?
Broadly speaking, a little bit of inflation, probably okay, maybe even supports the market, but high inflation, that tends to be bad news.
Through those multiple channels, higher company costs, lower consumer spending, rising interest rates, and dampen future expectations.
You got it. That combination usually acts as a drag on the market overall.
All right, so we know how high inflation can hurt the market. Now let's dive into which parts of the market feel it the most. Miss Mancy breaks down the vulnerable sectors. Where do we start?
Let's start with technology, tech stocks.
We touched on this already with the future earnings thing.
Exactly. Their valuations are often heavily tied to those long-term growth projections. High inflation and the rising interest rates that usually follow really hammer the present value of those future profits.
Plus, don't tech companies borrow a lot for R&D and expansion? Higher rates would hurt there too.
Definitely. Increased borrowing costs are another major headwind. Ms. Mancy mentioned companies like Infosys or Zomato as examples that can see pretty sharp drops when inflation bites.
And it's interesting, it might not even be about their specific performance, but just the overall economic weather changing.
That's a key point. The macro environment shifts investor sentiment, sometimes regardless of the company's own results.
Okay, so tech is vulnerable. What's next on the list?
Consumer discretionary. These are the companies selling things people want but don't necessarily need.
The non-essentials we cut back on first.
Exactly. Think cars. Miss Mancy used Maruti Suzuki as an example. Or travel, like Make My Trip, when household budgets get tight because food and fuel cost more.
New car vacation gets postponed.
Right. So sales drop for these companies, profits suffer, and stock prices often follow. It's a pretty direct hit.
Makes sense. Next up was real estate. How does inflation shake up the property sector?
Couple things here. First, as we said, inflation often leads to higher interest rates. That means higher mortgage rates.
Making it more expensive to buy a home.
Yeah, which can cool down demand significantly. Higher rates also make it more expensive for the developers themselves to finance projects.
Okay. And what about building costs?
That's the other hit. Inflation drives up the price of materials. Miss Mancy gave the example of cement, maybe an extra 1,000 euros per bag. That eats directly into the profit margins of developers like DLF or Oberoi Realty.
So pressure from both ends. Buyers face higher borrowing costs, and builders face higher material costs. A real double whammy.
Pretty much, yeah.
And the last really vulnerable sector mentioned was non-essential retail.
Right. Similar logic to consumer discretionary. Retailers selling clothes, electronics, things that aren't absolute necessities, they struggle when people are focused on essentials.
And they face rising costs themselves, right?
Yes. If their own costs go up, like Miss Mancy's example of a shirt costing $500 more to produce or acquire, they can't pass that increase on to shoppers.
Because shoppers just don't have the extra cash.
Then their margins shrink. That leads to weaker results and potentially falling stock prices. Think pantaloons, or the example of future retail, which shows how severe it can get.
Okay, so tech, consumer discretionary, real estate, non-essential retail, those tend to suffer most. Now let's flip it. Which sectors are more resilient? The ones that might actually do okay, or at least better, when inflation is high. Consumer staples was first.
Yes, consumer staples. These are the companies making the everyday essentials. Food, drinks, soap, toothpaste stuff people buy regardless of the economy.
Like Hindustan Unilever or Dabur India.
Exactly. The key here is they often have pricing power. They can usually pass on some, if not all, of their increased costs to consumers because people need these products.
Even if toothpaste costs €10, you still buy it.
Pretty much. So they can often protect their profit margins better than other sectors, which makes their stocks look relatively safe, even attractive during inflationary times.
Right, we grumble about prices but keep buying essentials. Okay, what's the next resilient sector?
Energy. This one's interesting because inflation often means higher energy prices. Oil, gas.
Ah, so the very thing causing inflation elsewhere can boost their revenues.
Directly. Ms. Mancy mentioned Reliance's energy arm, or ONGC. When crude oil prices go up, their top-line benefits. Plus, they tend to be less sensitive to rising interest rates compared to, say, tech.
So higher revenues from commodity prices and less pain from higher borrowing costs. A good combination for them.
It can be, yes.
What about healthcare? That feels like another essential area.
Absolutely. Healthcare is a classic defensive sector. People need doctors, medicines, hospital services, inflation or not.
Companies like Cipla or Apollo Hospital.
Right. And like consumer staples, they often have some ability to pass on increased costs, maybe that 50 more for a prescription Miss Mancy mentioned, because the demand is consistent.
So steady demand and some pricing power equals resilience.
That's the general idea, yes. It helps them hold up relatively well.
Okay. Now the last one Miss Mancy listed was financials, but with a bit of a maybe. Why the caution there?
Yeah, financials, especially banks like HDFC or SBI, are a bit more complex. On the one hand, higher interest rates can be good for them.
Because they earn more on the loans they give out.
Exactly. That difference between what they pay for deposits and what they charge for loans, the net interest margin can widen. Ms. Mancy used the example of earning, say, 5,000 more on a 10 lakh loan.
Okay, so that's the positive side. What's the risk?
Your risk is if high inflation really slams the brakes on the economy, if people lose jobs, if businesses struggle,
Loan defaults could rise.
that's the concern. More people and companies might not be able to repay their loans, which obviously hurts the bank's results. So it's a bit of a mixed bag potential for higher earnings, but also higher risk of bad loans.
Right, a potential boost from higher rates, but danger if the economy tanks. So just to quickly recap the rule of thumb.
Generally, the hardest hit sectors tend to be tech, consumer discretionary, real estate, and non-essential retail.
And the more resilient ones.
Usually consumer staples, energy, healthcare, and sometimes financials, keeping that caveat in mind.
Miss Mancy used 2022 as a real-world case study. Can you quickly walk us through what happened then?
Sure, so 2022 saw that big global inflation spike, around 9% in some places. India's CPI hit about 7%.
And what happened in the market?
Pretty much followed the script. Tech stocks, like the Nifty YIT index, took a hit as rates rose and future earnings looked less attractive.
Sure.
But energy companies like Reliance did relatively well because oil prices soared, hitting maybe 8,000 a barrel at points.
Wow. And consumer staples.
They were quite stable. Companies like ITC, selling essentials like Atta and soap, saw steady demand, which supported their stock prices.
That 2022 example really does illustrate those different impacts quite clearly.
Okay.
So wrapping up, based on Miss Mancy's insights, what are the key takeaways for you, the listener? What should you keep in mind?
Well, first, definitely keep an eye on inflation news. Watch those CPI numbers, see what the RBI is doing. If inflation stays high, say above 6%, that's often a sign of more bumps ahead in the market.
So stay informed. What else?
Diversification is always important, but maybe even more so when inflation is high. Having a mix, some of those defensive stocks like staples or healthcare, maybe some energy, alongside your growth stocks, can help manage risk.
Don't put all your eggs in one basket, basically.
Exactly. Also, consider commodity-linked stocks, energy, materials that can sometimes benefit directly from the rising prices that are inflation.
Good point. Anything else?
And finally, try to maintain a long-term view. Inflation can cause short-term turbulence, lots of ups and downs. Panic selling during those dips is often a mistake. Focus on the long run.
That's really solid advice. Understanding how inflation works through the market, it really does give you a better lens for, making sense of it all and maybe making smarter choices.
Absolutely. It's a fundamental piece of the puzzle.
So here's a final thought for you to maybe mull over after this. Think about what's happening right now globally, locally. Are there specific events or trends you see pushing inflation up or maybe even pulling it down?
Yeah, and how might those specific pressures affect the sectors we talked about? Maybe in ways slightly different from the general rules.
And consider government actions too, policies here in India or elsewhere. Could they make things better or worse for certain parts of the economy and therefore the market in this inflationary context?
It's always changing, always dynamic. But having this framework for how inflation works, well, that's a really powerful tool to have in your kit.